What are the odds you will jump ship on an investment? Well, it depends on how risky the investment is, doesn't it? But you can't measure risk. There is no set historical number that you can go look at. We think of risk as the probability of a bad outcome. And for this whiteboard session, we think a bad outcome is the amount of loss over a given time frame that would cause you to jump ship. Now, you don't jump ship because an investment is too risky. You do so because it's too volatile, don't you? And we can measure historical volatility through a tool called standard deviation. Now, we're not going to get into formulas or mathematical explanations, but for right now, just think of it as how much something fluctuates on a regular basis. And we can show this through a chart on our website, like the one we have here. In this particular chart, we plot the Porter investment strategies with respect to their compound annual growth rate on the right side with their volatility along the bottom. Now, to use an example, let's just take the retirement strategy here. If we look at the retirement strategy and we go over to the right, we can see, for purposes of illustration here, it averages about a compound annual growth rate of about 10%. And for that 10%, we're just going to say that it has a standard deviation of about 7%. What this means, or statistically, it has about a 68% likelihood in any given year of an annual return between about 17 and 3%, meaning 10% plus one standard deviation down and minus one standard deviation. But the other thing that we want you to look at as you look at this graph is the proportionality of it. And it just kind of makes sense as you look at the slopes of the plot graph here. As your return potential goes up, your volatility should proportionally increase. That's just kind of reality. And so one thing to keep in mind, though, when you're looking at a lot of other types of investments, is that many investments have standard deviations of greater than their compound annual growth rate. And sometimes we will make an investment in something and we do so because it has a great 2 or 3 or 4 year return. And then we end up losing 15 or 20%. And we think that's totally out of character. When in actuality, it's really not, because in any given year, a lot of investments that have that kind of return potential could certainly lose 20 or 25% in any given year. It just might not have done it in the look back period that you were analyzing when you were considering the investment in the first place. Now, the next whiteboard session we're going to have, or some future whiteboard sessions, we're going to talk about maximum drawdowns and why it's so important not to concentrate on that. Because unfortunately, maximum drawdown is not a statistical measurement and really has very little probabilistic value. But for right now, we hope this helps, and please let us know if we can help you.